China's banks just shocked the world, and you're not going to believe why they're panicking. Because right now, what's happening inside China's banking system is a warning to the global economy and the global banking system. I've been warning what's happening in China was going to spill over all across the world, but this is something that nobody saw coming. Now, I want to give you a little bit of backstory here because it wasn't long ago that rates in China were crashing, and it turned out that the banks were big buyers of bonds. And Beijing stepped in and said, look, you can't do this. You can't buy bonds. We don't want you buying bonds. And the bank said, look, we don't want to lend. Have you seen the state of the economy? Have you seen our real estate sector? We don't want to lend. And Beijing said, look, if you're not going to lend, then we're going to drive interest rates up. And shortly thereafter, yes, rates went up. And then Beijing panicked and said, look, we need to cut rates. But the problem is all along, the banks have been buying bonds. Now check this out. China's banks have bought $10 trillion worth of bonds, and that is a staggering number because right now a lot of people believe that rates are going to go higher. And if banks are sitting on bonds and rates go up, well, that means they're going to be facing large unrealized losses. This is exactly what happened here in the regional banks not too long ago. We saw rates go up, and next thing you know, there was a mass exodus of cash as we saw consumers and depositors yank their money. What happened? It nearly brought our banking system to its knees. And that's the issue you would face if you're in a low interest rate environment and rates are headed up. But China's banks are making the exact opposite bet here. Now, what we're seeing is commercial banks, such as China's construction bank, has raised their overall central and local government debt holdings by more than 20% year over year. So just at a time when we're hearing about the global economy plateauing, that's finally going to turn around because the global equity markets are leading the charge, the banks are loading up on bonds in a big way, now holding about 72 trillion yuan or about 10 trillion US dollars. This data as good as of August. Now the question you might be asking, why are they doing it? Well, simple, my friends. They are panicking, and for very good reason here. Now, they know rates are coming down. This is obvious. We heard from the Fed that, yes, they're going to do a dovish 25 basis point cut, meaning they're signaling going forward there's probably going to be another cut or two. But even from the Fed's perspective, and we're hearing this from central banks all over the world, that the next cut is the last one. There's going to be another one. But right now, the banks in China are betting that the PBOC is going to be slashing rates. And what you're going to find out, it's not just the PBOC is be cutting rates, it's every major central bank is going to be slashing rates by year end. And the reason behind this is very clear. China's economy is continuing to slow down and likely to enter a recession. We've talked about how consumer prices are actually negative and producer prices, and this is coming out of the factory level, have been negative for the past 3 years. So China, unlike a lot of other parts of the world, they're exporting deflation. And what China's banks realize very clearly here is you don't want to lend into a deflationary environment. You want to hold government bonds in a big way. Now, what's baffling here is that banks have quotas. Because Beijing comes out and says, look, you've got to lend. And they're saying, look, not a chance. All the stimulus you've done hasn't worked. We haven't seen the housing market recover. And guess what? We've lent a ton of money to these developers, and many of them are insolvent. The world doesn't know it yet, but they're teetering on the edge. And right now, China's economy is going the wrong direction. And this is one of the issues we're facing. I want you to see this chart. We're going to look at some U.S. data here. This is the delinquency rate against commercial industrial lending, that part shown in blue on a year-over-year rate of change. And this is the issue that China is facing right now, and we're going to see this all across banking systems of the world, is that as demand for loans decreases, which is what we're seeing in China, the delinquency rate is going to rise. Now, you'll notice this relationship going into each and every recession. And right now for the U.S., we've seen commercial industrial lending keep pace, and that's largely due to front running of the tariffs. But this isn't likely to last because once all this front running comes to an end, there's likely going to be a collapse in lending. Now, why is this a major problem? Because in a debt-based system, you need new loans to make the payments and pay off old debt. So when you see a contraction in lending, it's a major red flag for your economy. And in this case, you think about the banks who've lent out a bunch of money and they're going to face a slowing economy, rising delinquencies, rising defaults. What do you want to hold? Well, you better believe government debt, that is for sure. But something else you'll want to get a hold of, that's our trading reports. Let's update you on this trade we put back out on the 10th on symbol DAPP. Now, as of close of business yesterday, up 13.06%. Now, this was from our optimized meta strategy and went out to all of our subscribers. And my friends, we're changing the way people trade. Now, to get in on trades like this, all you got to do is sign up for one of my reports, whether you want to trade against the machines at CTA Timer Pro or trade momentum signals, that's Momentum Timer Pro. Grab those links in the description below. Use the coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. And the problem is, as lending slows, well, that means rates are coming down. Because when you think about what rates are telling us, it's just a function of growth and inflation expectations. So the banks realize this. If they're not lending because the economy is slowing. If the economy is slowing, rates are going to go down. And in that case, unlike Beijing, who's saying, look, banks, you got this wrong. Rates are going to go up. You're going to lose your shirt. The banks are betting big that China's economy is going to continue to fall. They're betting that China's stimulus plans, whatever they may be, aren't going to work. And they're also betting big that the global economy is going to follow them right down. Now let's take a look at commercial industrial lending against market yield on 2-year treasury yields. That's shown in red, and you can see very clearly here what the bond market is telling us about the banks, and that is as commercial industrial lending declines, again, this is U.S. data, what you see is 2-year treasury yields are moving down. Now let's look forward to where we're at right now, because right around early 2024, we saw a turnaround in commercial industrial lending. At the same time, we've seen a steady decline in 2-year yield. And why is that? Because the bond market here is telling us exactly what's going on in China is coming here and in the near future. It's saying, look, all this front running of the tariffs is coming to an end. Nothing we're doing is working. The Fed rate cuts aren't going to have any effect, and growth and inflation expectations are going to continue to fall. And that means what we're seeing from China's banks buying massive amounts of government debt, well, we're going to see that happen here in the U.S. as well. And the evidence always comes back to the loan book, and that will add to woes for banks that are already struggling with a growing pile of bad loans and record low margins, as well as threaten the government's ability to push through more stimulus to boost the economy. And this is exactly what I've been warning about. As you see an economy slow, you see loans go bad, and that's because what happens as you enter a recession or you have deflation like China has, there isn't enough new money being created in the economy to support growth and all of the debt. So in that case, what you get is effectively what looks like a currency shortage. Again, the music stops and, well, people don't have the money to pay on their debts. And that's what China's banks are saying right now. So look, we've done a whole bunch of lending. You asked us to, you forced us to, we lent it out. And then you said, look, we're going to do some stimulus here and we're going to turn the economy around. And it didn't work. And that's the problem China's banks have. They've got bad loans. They're going to get worse. And the problem is Beijing says, look, you need to lend even more. And they're saying, no, thank you. We want to load up on government debt because we know you're going to be forced to cut rates here. And despite what the stock market says, there are clear signs right now that the global economy is slowing. It just really hasn't hit the U.S. yet. Let's turn where we talk about what's coming out of China, and that is exports, those imports here into the United States. We're now hearing from the Port of Los Angeles. Executive Director Gene Circa told us reporters that I expect container volumes to ease to the rest of the year, especially against last year's unusually high comps. Now, you remember back to earlier part of this year when imports to the U.S. just cratered. They went virtually to zero. And what happened to the labor market or in the ports? Well, people went to work. And on the board, they have boards there to show kind of where there's work available. And there wasn't any work. And the next thing you know, it hit the local communities. And then spread all up and down the state and the supply chain as you heard transportation companies say, look, if this doesn't turn around and immediately, we're going out of business. So we can already see what China's banks are warning about is, look, there's going to be another leg down, largely because imports are coming down. And that's exactly what we're hearing from the Port of Los Angeles. Soroka said the Port of LA is likely to see about 850,000 containers in September, or about 10% less than the same month last year. So if you think about this from a labor market perspective, that means the demand for labor is going to decline. Now, even if people don't lose their jobs, what it means is they're going to get less hours, less imports, less hours. And this is perhaps what workers have been warning about. This may be what we've been seeing in the survey data is everybody is well aware that the demand for the U.S. economy is declining, imports are going down, and that means work is about to drop. Let's take a look at this chart of imports versus average weekly hours of production and non-supervisory employees. And you can see the very clear relationship, as you know, going back into the late 80s, as imports decline, what happens? Average weekly hours going right down alongside that. In fact, you can see there's a great relationship between the two. So the risk the U.S. economy was facing right now, the risk that China's banks are warning about right now is that, look, exports from China are going down. That means, of course, their economy is going to continue to slow. But they are also saying at the same time, if that means our exports are going down, imports into the U.S., they're going to drop. And that means the risk to rising unemployment is going to become the foremost issue here in our country. And again, I think this is exactly what workers realize, because if you look back on this chart, what do we see? Imports now crashing down just as I predicted. And what this is suggesting is that hours worked might hold up here for the next couple of months, but it's not going to last. It means hours worked are about to come plunging down. And if you think about it, it makes absolutely perfect sense what we're hearing, because what do we hear in the surveys? Consumers are worried about their jobs. They're worried about paying their bills. And what have we heard about holiday spending? Everybody says it's going to decline. But the issue is, for businesses all around the country, all around the world, is everybody bought into the fact that the economy was going to boom out of the pandemic. It didn't. And then everybody bought into the fact it was going to boom into the second half of 2025. And it didn't. And now we've got a 25 basis point cut from the Fed because the labor market's weakening. But the problem is, based on the fact that we're seeing imports coming down, it tells us already that the labor market here is going to further weaken. Of course, the main issue here for U.S. consumers, they can't afford higher prices. Let's take a look at this chart of advanced retail sales versus average weekly hours of production and non-supervisory employees. And we can make the case that weekly hours likely to decline. If nothing else, they're not likely to go higher, but stay the same. And if you look at the relationship between retail sales, you can see very clearly that this trend in retail sales that is pushing higher is unsustainable, because once again, workers do not have the income to keep pace with sales. And this is a problem, because this is what China's banks are trying to tell us. Look, demand for our exports is going down, which means demand for imports in the U.S. is going down. And it's all because the U.S. consumer is pulling back because they can't afford higher prices. Again, why retail sales aren't going to continue to push higher, which is likely to lead to further unemployment. And of course, all that back feeds into weaker industrial production. Again, exactly what we're seeing in China right now. U.S. industrial production rose 0.1% month over month in August. The year-over-year rate of change slowed to 0.9%. So these are very weak growth rates. But there is something more important about the industrial production data, my friends. It's called capacity utilization. Now in China, their issue is we have too much capacity. They call it anti-involution, where they're trying to keep producers from lowering their prices. The problem is, when you have too much capacity, or simply said, a lack of demand to meet the capacity that you can create, what happens? It leads to rising unemployment. Now let's take a look at this chart here of capacity utilization against average weekly hours of production and non-supervisory employees. And what you can see at the factory level, as the capacity of the factory declines, that's what it's showing in the blue line, well, the need for employees goes right down with it. The initial move is you cut hours, you cut job openings, and then if it persists, you cut jobs. And you can see that relationship going forward here. And so as we talk about the U.S. economy, we talk about the U.S. consumer here and a potential rebound, which is what the stock market's trying to tell us is going to happen. But at the real level economy, what the real consumer is telling us is that's not going to happen at all. Because if imports are going down and capacity utilization is going down, what it's very clearly telling us is weekly hours aren't going up. In fact, the risk is, my friends, that they're likely to go down. But right now, for the moment, the labor market seems stable as we turn to initial jobless claims, as they drop by the most in almost 4 years. Initial claims decreased by 33,000 to 231,000. Continuing claims, meanwhile, this is a proxy for the number of people receiving benefits, that declined to 1.92 million. So perhaps what we're seeing is some hiring ahead of the holiday season, which is great for the economy. But what I want to suggest is this is unsustainable. It's not likely to last. So for the moment, what we're seeing is the labor market appears stable, but with spending set to decline and inventory still building, it's not likely to stay stable much longer. And that's the risk here, because what we continue to hear from U.S. consumers is they're financially stressed, they're financially tapped out, and as they continue to worry about losing their jobs, their spending is going to go down, and that is going to be the tipping point for the U.S. economy, and why I think the labor market here may be stable today. We may be plateauing, but I don't think it's going to turn around to the upside. I think we're right on the edge of another major move to the downside. So what we're waking up to is a realization that businesses cannot push up higher prices, and instead, because demand isn't there, in fact, demand's weakening at a faster rate, what China's banks are telling us is the global economy is headed right into a recession. And this is what's so shocking to the world right now, because everybody's looking to the U.S. to drive the consumer spending, to turn the global economy around. And what we're seeing in China's banks of all their bond purchases, well, watch out. One of these days, you're going to hear that U.S. banks are big buyers of bonds, and it's very clear why, because they know that the U.S. economy is weakening, they know the U.S. consumer is financially strapped, and they know that we're not at a plateau and turning higher. They know that at the end of this plateau, which is coming soon, we're at the tipping point for the next move down, and the risk is that next move down is called a global recession. And my friends, that's the best case. The real case, we're facing an all-out global financial crisis. Even if the economy heads into a financial crisis, it doesn't mean your trading account has to go down with it. Let's talk about the trade we put out on DAPP back on the 10th. This went out to all our subscribers. Now, this was from our new optimized meta strategy, and my friends, we're about to change the game with it again. Now, what is our meta strategy? Well, right now, it is an advanced trading system that combines 9 trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies on their own. Now, it has multi-strategy consensus, but what we did is we optimized every one of those strategies on a per security basis, and we saw some amazing results. Now, we already programmed it to target a 10-day hold period, and this thing has an amazing success rate. Let's take a look at the numbers, because this is from a custom backtest engine I built to model real-world trading. Look at this. On a 3-year test on SPY, had a total return of 71%, beating a buy and hold strategy, a win rate over 66%, which is amazing. Max drawdown right around 7.4%. Now let's compare this to an unoptimized strategy, one that you need a lot of other tools to trade to even have even close to same success. That's my buddy Jay Bravo, the Bravo 9. Look at this, total return missing, buy and hold, only 51%. Win rate, 51.5, paltry compared to ours, half the number of trades, same drawdown. Now, how do you take advantage of the strategy? How do you start trading and winning? How do you even replace your existing strategies? It's really easy, my friends. Now, I have 2 reports that this is included right now at no additional charge. Now, one of those is called CTA Timer Pro. We trade against the machines. We look at machine positioning each and every day. The other report called Momentum Timer Pro, we look at momentum indicators and trend indicators, and we pair them together. Now, if you sign up for either report, you get that report and all the tradable signals from it. On top of that, you get those meta strategy trades. You get my opinion on the best trades, risk control levels, a full tracking of all open trades and returns, a weekly update, and here's the best part. You don't have to put a dime out to try reports or to compare it to any other trading system you're using. All you got to do, grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.